Welcome to the Deep Dive. If you've ever glanced at a company's financial report and felt like you were trying to decipher ancient runes, well, you're definitely not alone. It can be a dizzying amount of information.
Absolutely. Companies release so much data, and for good reason, right? It's critical for understanding their health, their performance. But yeah, for many people, it often feels like trying to navigate a maze blindfolded.
That's exactly why we're here today. Our mission is to, cut through all that jargon and really demystify core financial reporting.
Mm-hmm.
We're going deep into everything from balance sheets to earnings per share, even how companies handle those tricky accounting changes and mistakes.
Right. The stuff that can really change the picture.
Think of this as your shortcut, really, to understanding what's actually behind the numbers that drive business decisions and, well, market movements too. We want to uncover some surprising insights, those crucial details that often get overlooked, give you a real edge.
Sounds like a plan.
Okay, let's unpack this then. We talk about financial statements all the time, but what exactly makes up a full set of these general purpose statements under U.S. GAAP? And why is this whole set so important?
Excellent question to start with. So when we talk about general purpose financial reporting, we mean a comprehensive package. It's designed to give you, well, the complete picture.
Correct.
This package includes a full set of financial statements, plus their accompanying notes, and those notes are really crucial for context.
Right, the fine print.
Exactly. There are 5 key statements. First, the statement of financial position, most people know it as the balance sheet. Then the statement of earnings, or income statement.
Okay.
Then the statement of comprehensive income, the statement of cash flows, and finally, the statement of owner's equity.
So 5 key pieces.
Right. And together, they're not just isolated bits of data. They combine to give you this holistic view of a company's financial health, its performance over time, and, crucially, how it's generating and using cash.
Got it. So the balance sheet. You said statement of financial position. That's like a financial snapshot, right? At one specific moment. What are the key things we should be looking for there?
Precisely. It's a snapshot. Think of it like a freeze frame of a company's financial health at a single point in time.
Mm-hmm.
It lays out what a company owns, what it owes, and what's left over for the owners. Companies usually present it in one of 2 ways.
Okay.
Either classified, which means it clearly separates current items, things expected to turn into cash, or be paid within a year from non-current longer-term items, or less common, it might be liquidity-based, which just lists things by how easily they can become cash.
Okay, so walk us through those big categories then. What typically falls into assets, liabilities, and that owner's part, equity?
Sure. On the asset side, what the company owns, you'll usually start with current assets. These are things like cash, accounts receivable, that's money owed to the company, inventory, things like that.
Yeah.
These fuel the day-to-day operations.
Right, the quick stuff.
Exactly. Then you have investments, which are usually longer-term holdings, maybe in other companies or securities. Next is property, plant and equipment, or PP&E.
Ah, yes, PP&E.
That's your physical stuff, land, buildings, machinery, the long-term workhorses. And importantly, it's shown less the accumulated depreciation, the wear and tear over time.
Okay.
After that, we have intangible assets. These are non-physical things like patents or goodwill, that extra value you get from buying another company. And finally, there's usually an other assets category for anything else that doesn't fit neatly.
Okay, that covers what they own. What about the other side? What they owe and the owner's stake, the rest of the balance sheet equation?
Right. So the other side starts with liabilities, what the company owes. Like assets, these are split. You have current liabilities, which are obligations due within a year. Think accounts payable money owed to suppliers or the current part of long-term debt.
Makes sense.
Then you have long-term liabilities, debts due further out, like bonds payable or maybe pension liabilities.
Mm-hmm.
And lastly, and this is really key, you have stockholders' equity.
The owner's piece.
Exactly. It's the owner's claim on the company's net assets after all the debts are paid. Its components include capital stock, that's preferred and common stock, the direct investment by owners, then additional paid-in capital, which is any amount paid above the SIC's basic value,
Okay.
and retained earnings. These are the profits the company has kept over time, not paid out as dividends. You'll also see accumulated other comprehensive income. We'll definitely circle back to that one, and maybe treasury stock as a deduction, which is stock the company bought back. It really gives you the ultimate picture of financial strength and leverage.
Got it. So the balance sheet is the snapshot. Now let's pivot to the income statement or statement of earnings. How did this statement tell a company's story over a period of time, like a quarter or a year?
Yeah, the income statement is definitely a story. It's a narrative of financial performance over a specific period. Its core purpose to show where the funds came from, revenues and gains, and where they went, expenses and losses. This statement is incredibly useful for evaluating profitability, assessing investment value, checking credit worthiness, and maybe most importantly, predicting future cash flows based on what happened in the past. It gives you insight into operational efficiency.
Now, when we're talking revenues and expenses, there's some specific terminology. What's the difference between cost and unexpired costs? It sounds a bit, well, jargony.
It can seem that way, but it's pretty intuitive once you break it down. Cost is simple. It's the amount you actually spent on something, like buying equipment or paying salaries.
Right, what you paid.
Exactly. Now, unexpired costs. These are costs that haven't been fully used up yet. They're basically assets that will become expenses in future periods.
Ah, okay, like prepaid rent.
Perfect example. Prepaid rent or prepaid insurance. You pay up front, it sits on the balance sheet as an asset and unexpired cost. Then, as time passes or you use the service, it gradually moves to the income statement as an expense. Inventory is another big one. It's an unexpired cost until you sell the item. Then it becomes cost of goods sold, an expense.
That makes perfect sense. Okay. And what about this gross concept for revenues and expenses versus the net concept for gains and losses? Why the difference there?
Good question. The distinction is really about the level of detail and what kind of activity it represents. Under the gross concept, revenues and expenses from your main ongoing operations are reported at their full amounts.
So no subtractions yet.
Right. Revenue is the total amount you expect from selling your goods or services. Expenses are the full costs incurred to generate that revenue. It gives you a clear picture of the total inflows and outflows from your core business, like seeing the full menu price and all the ingredients cost separately.
Okay.
The net concept, on the other hand, is used for gains and losses.
Yeah.
These usually come from activities outside the main business. They're reported net, meaning proceeds minus the book value of whatever was sold.
Like selling off old equipment.
Exactly. A gain is when you sell something, like that old equipment, for more than its value on your books. It wasn't your main business, but you made a profit. A loss is the opposite. Maybe selling an investment for less than its book value.
Oh.
This distinction is crucial because it helps you, the reader, understand if profits are coming from the core business, the gross stuff, or from these peripheral, maybe one-off net events. A company might look profitable just because it sold a building, you know? That's different from consistent profits from selling its actual products.
Definitely. So what are the different ways companies can present this income information? Are there different formats? And what are the pros and cons for us trying to read it?
Yeah, there are mainly two formats you'll see. The multiple-step income statement and the single-step income statement.
Okay.
The multiple-step format is often preferred by analysts. It separates operating revenues and expenses, the core business stuff, from non-operating items like interest income or gains from asset sales.
So it breaks it down more.
Right. It gives you more layers, more enhanced user information, as the accountants say. You can easily calculate key ratios like gross margin, which is sales minus cost of goods sold. You clearly see income from operations, the profit just from the main business before you get to other things.
Like in that Radon Industries example you mentioned.
Exactly. With Radon, you see net sales, then subtract cost of sales to get gross margin, then subtract operating expenses to get income from operations, then you add or subtract the other revenues expenses to get income before tax, and finally, income from continuing operations. It's layered.
That sounds really useful for digging in. What about the single step?
The single-step income statement is much simpler, as the name suggests. It literally has one step. You group all revenues and gains together, group all expenses and losses together, and then subtract the total expenses from total revenues to get income before tax.
So just one big subtraction.
Pretty much. The main benefit is its simplicity. It avoids implying that, say, operating expenses are somehow more important than interest expense because they're all just lumped together. Both formats get you to the same final net income, but the multiple step gives you more milestones along the way, more insight into how the company got there.
Okay, here's where it gets really interesting for me. Sometimes companies decide to, well, shut down or sell off a major part of their business. How is that shown?
Yeah.
Because that seems like it would really skew the picture of the ongoing operations.
You're absolutely right. It's a critical distinction, and GAAP handles it very carefully. When a company discontinues a significant part of its operations, the results from that part are reported separately on the income statement.
Okay, separate line item.
Exactly. It appears below the income from continuing operations line. And very importantly, it's reported net of tax. This separation is crucial so that you can clearly see how the ongoing core business is performing without the noise from the part being disposed of.
So it's not just any old asset sale.
Definitely not. It has to represent a strategic shift that has a major effect on the company's overall operations and financial results. Think big things, selling off operations in a major geographical area, getting rid of a whole line of business, selling a major investment you accounted for using the equity method.
Like that AmServe example, selling the fast food part to focus on health food.
Perfect example. If that fast food division was a huge part of their revenue and profit, selling it off to pivot to healthy options is a clear strategic shift. Its results, past and present until the sale, would be pulled out and shown separately as a discontinued operation.
And what actually goes into that discontinued operations section? Is it just the profit or loss from that division while they ran it?
It's a bit more comprehensive than just that. It includes three potential things, all shown net of tax. First, the actual results of operations of that component for the period up until it's classified as held for sale or disposed of. Second, any gain or loss on the actual disposal itself when it happens. And third, any impairment loss recognized if the value of that component drops significantly while it's marked as held for sale.
Ah, so if they decide to sell it and realize it's worth less than they thought.
Precisely. Once they decide to dispose of it, they have to measure it at the lower of its carrying amount, what it's worth on the books, or its fair value minus the cost to sell it. If fair value is lower, that difference is an impairment loss, and it goes into discontinued operations. Also, once it's marked for disposal, you stop depreciating or amortizing its assets.
So using that all sports company example, selling the golf division, how would that look over, say, 2 years?
Right. Let's say in year one, they decide to sell the golf division. Their income from continuing operations, everything else, might be $4 million. Below that line, under discontinued operations, they'd report two things for the golf division. Its operating loss for year one, say $2 million, and maybe an impairment loss if its value drops, say $1.8 million. Both of those would be shown net of their tax effect.
Okay, so year one shows the loss leading up to the sale decision and the impairment.
Correct. Then, in year two, let's say they actually sell it mid-year. Under discontinued operations for year two, they'd show the operating loss of the golf division from the start of year two until the sale date. And then they'd show the actual gain or loss on the sale itself, comparing the final sale price to the carrying value it had at the end of year one after the impairment. Again, both amounts shown net of tax. This clear separation lets you immediately see the performance of the core ongoing business in both years.
That makes a huge difference in understanding the trends. Okay, shifting gears slightly. Businesses operate globally, dealing with different currencies. How do gains and losses from those foreign currency transactions show up?
Great point, especially now. Foreign currency transaction gains and losses pop up when a company buys or sells something with a foreign partner and agrees to pay or receive payment in that foreign currency.
So not in their home currency.
Exactly. The risk, or potential reward, comes from changes in the exchange rate, the price of one currency in terms of another between the time the deal is made and the time the cash actually changes hands.
Okay.
We talk about the current exchange rate or spot rate, that's today's rate, and a transaction is denominated in a currency if that's the currency used for payment.
Right.
Gains or losses happen if that exchange rate moves between the transaction date and the payment date. And importantly, if a transaction isn't settled by the end of a reporting period, say December 31st, the company has to calculate any unrealized gain or loss based on the spot rate at that date and recognize it in current net income.
Even if they haven't paid or received the cash yet?
Correct. The asset, like a receivable or liability, like a payable, that's denominated in the foreign currency is adjusted to its current US dollar value at the balance sheet date, and the change hits the income statement.
Can you walk us through a quick example, like that Alento company one?
Sure. Let's say Alento buys goods for 100,000 pesos on December 1st. The exchange rate then is $0.10 per peso. So they record accounts payable of $10,000.
Okay, 100,000 times 0.0.
Right. Now fast forward to December 31st, their year end. The rate has dropped to $0.08 per peso. They haven't paid yet, but that 100,000 peso liability is now only worth $8,000 in US dollars.
Ah, so it costs them less in dollar terms now.
Exactly. So they recognize a $2,000 unrealized foreign exchange gain in their year one income statement, and they adjust the accounts payable on the balance sheet down to $8,000.
Okay, gain in year one. What happens when they pay?
Let's say they pay on February 1st of year two, and the rate has ticked back up to 0.99 cents per peso. To pay the 100,000 pesos now costs them $9,000. But remember, the liability on their books was only $8,000 at year end.
Right.
So when they pay the $9,000, they record a $1,000 foreign exchange transaction loss in year two. $9,000 cash paid minus the $8,000 liability. So you see how the timing of rate changes and settlement really matters for when the gain or loss hits the income statement? It shows the volatility global companies face.
Definitely highlights that risk. Okay, so sometimes you hear that net income doesn't tell the whole story about financial performance. What else do we need to know beyond just that bottom line number?
You've hit on a really crucial point there. While net income is absolutely fundamental, it doesn't capture every change in a company's overall value or equity that comes from non-owner sources. That's where comprehensive income comes into play.
Comprehensive income, okay.
Think of it as a broader measure. It's defined as the total change in equity during a period from all sources except investments by owners and distributions to owners, like dividends. The basic equation is pretty simple. Net income plus other comprehensive income equals comprehensive income.
So net income plus. Other comprehensive income, or OCI. What exactly are these OCI items? Are they like hidden adjustments?
Hidden might be strong, but they are things specifically excluded from net income under U.S. GAAP. Other comprehensive income, OCI, includes certain revenues, expenses, gains, and losses that affect a company's equity but aren't considered part of its regular recurring operational performance.
Okay, like what kind of things?
Some key examples include certain pension adjustments for companies with defined benefit plans. Another big one is unrealized gains and losses on certain investments classified as available for sale debt securities.
Unrealized, meaning they haven't sold them yet.
Exactly. The value went up or down, but they haven't locked in that gain or loss by selling. Same idea applies to certain qualifying hedging activities. Also, foreign currency items, specifically translation adjustments. That's when a U.S. company converts the financial statements of its foreign subsidiary into dollars. Those changes in value due to exchange rates go into OCI.
Ah, different from the transaction gains losses we just talked about.
Right. Translation is about converting whole financial statements. And one more, slightly complex one. Changes in the fair value of a company's own debt due to changes in its instrument-specific credit risk if they elected the fair value option. Basically, these are value changes that impact equity but aren't part of day-to-day earnings.
So these OCI items bypass net income initially. Do they ever make it into net income, or do they just live in the separate OCI world?
They don't live there forever, usually. That's where reclassification adjustments come in. When an OCI item is eventually realized, like when that available for sale security is actually sold, an adjustment is made to move it out of OCI and into net income in that period. This avoids double counting the item.
Okay, so it eventually flows through.
Right. And all these OCI items, current and past, accumulate in a specific section of stockholders' equity on the balance sheet called Accumulated Other Comprehensive Income, AOCI.
Ah, AOCI.
Think of it like a sibling account to retained earnings. Net income gets closed out to retained earnings each year. OCI gets closed out to AOCI. It tracks these specific non-owner equity changes separately.
So how is this comprehensive income actually presented? Does it get its own statement?
It has to be displayed with the same prominence as the other main financial statements, yes. Though companies without OCI items don't need to show it, and importantly, it's never reported on a per-share basis.
Okay, so what are the presentation options?
There are two main ways. First, the single statement approach. Here, you have your regular income statement getting down to net income, and then immediately below that, on the same page, you list out the OCI items, net of tax, and then arrive at a final comprehensive income number.
So all on one page.
Correct. Like with Sydney Technologies' example, you'd see net income, then maybe unrealized gains on securities, net of tax, foreign currency adjustments, net of tax, leading down to total comprehensive income.
And the second way.
The second is the two-statement approach. You have the standard income statement ending with net income. Then you present a separate second statement that starts with that net income figure, lists the OCI components, net of tax, and then sums them up to comprehensive income.
So two distinct statements back to back.
Exactly. Both methods show the same information, just formatted differently. Companies also have to disclose details about the tax effects on OCI items and show how the AOCI balance changed during the period.
All right, let's tackle one of the most talked about numbers in finance. Earnings per share, EPS. What exactly is it, and why does everyone, pay so much attention to it?
EPS is huge, especially for public companies. It's basically the company's profit allocated to each outstanding share of common stock. It's seen as a key indicator of profitability on a per-share basis, how much earnings power is behind each share you might own.
And it's required on the income statement itself.
Yes, right on the face of the income statement for public entities. Its importance lies in allowing investors to easily compare profitability between companies or track a single company's performance over time on a per-share level. How it's presented depends on the company's capital structure.
Okay.
If a company has a simple capital structure, basically just common stock, no convertible stuff, they
Right.
present basic EPS. But if they have a complex capital structure, meaning they have securities that could become common stock and dilute ETS, they must show both basic EPS and diluted EPS.
Basic and diluted.
Okay,
And if they're discontinued operations?
good point. If there are discontinued operations, the EPS for that component must also be shown separately, either on the face of the income statement or in the notes.
Got it. So let's start with basic EPS. Simple capital structure. How's that calculated?
For a simple structure, basic EPS is pretty straightforward. The formula is income available to common shareholders, weighted average number of common shares outstanding.
Income available to common shareholders. How do you get that number?
You start with income from continuing operations, or net income if there are no discontinued ops, and then you subtract any dividends declared on non-cumulative preferred stock and any dividends accumulated, whether declared or not, on cumulative preferred stock.
So you have to account for the preferred shareholders first.
Exactly. Common shareholders get what's left after the preferred claims are met. If there's a loss, you still subtract the preferred dividends, which actually makes the loss per common share even larger.
Okay. And the denominator. Weighted average shares.
Right. The weighted average number of common shares outstanding. It's the average number of shares held by the public throughout the period. You have to time weight any shares issued or repurchased during the period. If shares were issued halfway through the year, they only count as half a share in the average, for example.
Makes sense.
Yeah.
What about stock splits or stock dividends?
That's a crucial point for the weighted average calculation. Stock dividends and stock splits are treated retroactively. You adjust the share count as if the split or dividend happened at the beginning of the earliest period presented.
So even if a split happens in December, you recalculate the average for the whole year as if those extra shares were there all along.
Exactly. And for any prior comparative years shown too. This ensures comparability. You're comparing apples to apples in terms of share count across periods. Even if the split happens after the year end but before the financial statements are issued, you still have to adjust retrospectively.
Wow, okay. That's a key detail. Now, if a company has more than just common stock, things get more complicated, right? The complex capital structure.
Yes. That's when we need to calculate diluted EPS alongside basic EPS. A company has a complex capital structure if it has securities outstanding that could potentially be converted into common stock and, if converted, would decrease or dilute earnings per share.
What kind of securities are we talking about?
Things like convertible preferred stock, convertible bonds, stock options, stock warrants, even certain contracts that could be settled in stock, or contingent shares that might be issued if certain targets are met.
So potentially more shares hitting the market.
Exactly. The whole point of diluted EPS is to show a worst-case scenario for common shareholders. What would EPS look like if all these potentially dilutive securities were converted or exercised?
So how does the formula change for diluted EPS?
The formula adjusts both the numerator, earnings, and the denominator, shares. It's generally income available to common shareholders plus adjustments for dilutive securities. Weighted average shares plus additional shares from assumed conversion exercise. You're basically adding back interest, net of tax, for convertible debt, or adjusting for preferred dividends not paid on convertible preferred, and adding the potential new shares to the denominator.
Okay, let's break that down. How do you figure out the dilution from things like stock options or warrants? You mentioned a special method.
Right. For options and warrants, we use the treasury stock method. It's a bit counterintuitive at first. It assumes the options are exercised.
Okay.
Then it assumes the company takes the cash proceeds it received from the exercise and uses that cash to buy back its own shares in the open market at the average market price for the period.
Huh. Why buy back shares?
The logic is that the cash inflow shouldn't artificially benefit EPS, so you assume it's used to repurchase shares. Now, if the exercise price is lower than the average market price, meaning the options are in the money, the company won't be able to buy back all the shares it just issued from the option exercise.
Ah, because the market price is higher than the exercise price they received.
Exactly. So the difference, the number of shares issued minus the number of shares repurchased, represents the net increase in shares, the actual dilution. That net increase is added to the denominator for diluted EPS.
What if the market price is below the exercise price?
Great question. That's the critical concept of anti-dilution. If the average market price is less than the exercise price, the options are out of the money. No one would exercise them. In this case, they are considered anti-dilutive and they're completely excluded from the diluted EPS calculation.
So only in the money options count for dilution.
Precisely. Diluted EPS should only ever be equal to or lower than basic EPS. If assuming conversion or exercise makes EPS go up, you ignore that security for the calculation.
That makes sense. It's supposed to be a worst case number.
Right.
Okay, what about convertible securities like bonds or preferred stock? They don't generate cash proceeds when converted, so the treasury stock method doesn't apply, right?
Correct. For convertible bonds and convertible preferred stock, we use the if converted method. This method assumes the conversion happens at the beginning of the period or the issue date if later.
Okay, so what adjustments do you make?
For convertible bonds, if you assume they convert, the company wouldn't pay interest on them anymore. So you add back the interest expense that would have been saved, adjusted for taxes, so interest expense net of tax, to the numerator, the earnings, and then you add the common shares that would result from the conversion to the denominator.
Add back interest saving, add the new shares.
Right. But again, you must check for anti-dilution. You calculate the impact of converting just the bonds. If doing so makes the EPS figure higher than basic EPS, then those bonds are anti-dilutive for that period, and you exclude them from the final diluted EPS calculation.
Wow. So even convertible bonds might not be included if they actually increase EPS upon conversion.
Exactly. It's a crucial check. I remember seeing an example where X company's bonds were anti-dilutive. Converting them actually raised EPS from $1 to $1.14. So for diluted EPS, you'd ignore the bonds entirely. It's all about showing the maximum potential dilution.
Oh, it's a fantastic aha moment. Okay, what about convertible preferred stock? Same idea.
Very similar logic for convertible preferred stock. If you assume conversion, the preferred dividends wouldn't be paid. So for the numerator adjustment, you don't subtract the preferred dividends, or you add them back if you already subtracted them for basic EPS. You just use income available to common shareholders before considering those specific convertible preferred dividends. Then you add the shares from the assumed conversion to the denominator.
And check for anti-dilution again.
Always. Calculate the impact of converting just the preferred stock. If it reduces EPS, include it. If it increases EPS, exclude it. You have to test each potentially dilutive security individually and sometimes in combination to ensure the final reported diluted EPS reflects the maximum possible dilution.
Got it. Test everything, only include what lowers EPS. Are there other things that cause dilution?
Briefly, yes. Things like contracts that can be settled in cash or stock, you generally assume they're settled in stock if that's more dilutive. Also, contingent shares, shares promised if certain conditions are met. You include them in diluted EPS if the conditions have already been met by the end of the period, or if they would be met based on the current status if the contingency period ended today.
Seems like there's a lot to disclose around EPS.
There is. Companies need to show a reconciliation of the numerators and denominators used for basic and diluted EPS. They need to disclose the impact of preferred dividends, identify any potential common shares not included because they were anti-dilutive, and mention any significant transactions after the period end that could affect shares outstanding. Transparency is key for this widely watched metric.
Okay, fascinating stuff on EPS. Let's move from the flow of income to the backbone of the company, its ownership structure, stockholders' equity. What does that section of the balance sheet really represent?
Right. Stockholders' equity, sometimes called shareholders' equity or just equity, is the owner's claim on the net assets of the corporation. It's simply assets minus liabilities. It's usually the last major section on the balance sheet. The key presentation requirement is that it must be classified by source so you can see where the capital came from.
So what are the main sources or categories you'd see in that section? Like in that capital core example?
Looking at a typical equity section like capital cores, you'll see the main categories clearly laid out. First, capital stock, which is the par or stated value of the shares issued broken down into preferred stock and common stock. This represents the legal capital.
Legal capital. What's that again?
Legal capital is basically the amount of capital that must be retained by the corporation for the protection of its creditors. It's typically the par value, an arbitrary amount assigned in the charter, or stated value of the stock. It's a minimum floor of capital that can't usually be distributed back to shareholders.
Okay. So capital stock is the par value part. What's next?
Next is additional paid-in capital, often abbreviated as APAC. This is the amount shareholders paid in excess of the par or stated value when the stock was originally issued.
Got it. Excess over par.
Then you have retained earnings. This is the big one. It's the accumulated net income of the company over its entire life, minus any dividends it has paid out to shareholders. It represents the profits reinvested back into the business. You'll also see accumulated other comprehensive income, AOCI, which we discussed earlier, those specific gains and losses that bypass net income but affect equity. And finally, you'll often see treasury stock listed as a reduction or contra equity account. This represents shares the company has bought back from the market. Sometimes you might also see a line for non-controlling interest if it's a consolidated statement.
Let's drill down on capital stock a bit. You mentioned authorized, issued, and outstanding shares earlier. Can you recap the difference? It can be tricky.
Absolutely. Authorized shares are the maximum number the company is legally allowed to issue according to its corporate charter. Think of it as the upper limit. Issued shares are the number of authorized shares that have actually been sold or distributed to shareholders at some point. Outstanding shares are the issued shares that are currently held by investors, meaning issued shares minus any shares the company has bought back as treasury stock.
So issued minus treasury equals outstanding.
Exactly. And companies have to disclose these numbers. Outstanding shares are the ones that have voting rights and receive dividends.
Okay. Now, common stock seems pretty straightforward. Basic ownership, voting rights, potential for dividends and growth, but last in line if things go wrong.
That's a good summary. Common stockholders hold the basic ownership, bear the ultimate risk, but also reap the ultimate rewards through dividends and appreciation. They generally control management through voting rights, and they share in earnings and assets upon liquidation, but only after creditors and preferred stockholders are paid.
You mentioned book value per share. How's that calculated?
Book value per common share is a way to measure the net asset value backing each share. The formula is common shareholders' equity, common shares outstanding.
And how do you find common shareholders' equity? Is it just total equity?
Not quite. You need to isolate the equity attributable only to common shareholders. So you take total shareholders' equity, subtract the equity related to preferred stock, usually the greater of its call price or par value, and also subtract any cumulative preferred dividends that are in arrears, owed but not yet paid. What's left is the equity belonging to the common stockholders.
Got it. Now, preferred stock. You said it has preferences. It sounds like it comes in many flavors.
It really does. Preferred stock is a hybrid. It has features of both debt and equity. Its preferences give it priority over common stock in certain situations.
Talking dividends.
Yes, dividends are a big one. Is it cumulative versus non-cumulative?
No.
If it's cumulative, any missed dividends in arrears, must be paid before common shareholders get anything. If it's non-cumulative, missed dividends are just lost forever. That's a huge difference for investors.
Definitely. What else?
Is it participating versus non-participating? Participating preferred stock gets its stated dividend, plus it can share in additional dividends alongside common stockholders, often up to a certain limit. Non-participating just gets its fixed preference amount, nothing more. They almost always have a preference upon liquidation over common stock, meaning they get their investment back, usually par value or sometimes a higher liquidation value, before common shareholders get anything if the company dissolves. They might also be convertible into common stock at the holder's option or callable, redeemable, at the company's option, meaning the company can force the shareholders to sell it back at a specified price.
And you mentioned some preferred stock is actually treated as a liability.
Yes, that's mandatorily redeemable preferred stock. If the stock must be redeemed, bought back by the company on a specific date or event, it's essentially like debt with a maturity date. So under GAAP, it's classified as a liability on the balance sheet, not equity. That's a key classification point.
That cumulative participating preferred stock sounds like it could make dividend calculations really complex, especially if dividends were missed. Like that Samuel Coe example you walked through earlier.
It does add layers, but the logic follows the preferences. Let's revisit Samuel Coe. They have cumulative participating preferred stock and common stock. They skip dividends in year one but want to pay in year two.
So who gets paid first?
First, the preferred dividends and arrears from year one. Because it's cumulative, you have to catch up on those missed payments.
Okay, year one preferred paid.
Second, the current year's year two preferred dividend. They get their regular dividend preference for the current year.
Right.
Third, because it's participating, the common shareholders get a matching dividend. Usually this means common gets a dividend percentage based on their par value that equals the preferred stock's dividend percentage based on its par value. This ensures a level playing field before extra distributions.
So common gets brought up to the same level.
Exactly. And fourth, if there's still money left to distribute after all that, it's shared between the preferred and common stockholders, usually pro rata based on the total par value of each class of stock. It ensures the preferred holders get their guaranteed return plus a share of the excess profits according to the participation feature. It's all about following the specific rights laid out in the stock agreement.
That clarifies the hierarchy nicely. Okay, moving down the equity section. Additional paid-in capital, AP. You said it's mainly the excess over par value.
That's the main source, yes. AP is contributed capital money paid in by shareholders that's above the legal capital, par or stated value, but it can also arise from other equity transactions.
Like what?
For example, if a company resells treasury stock for more than it cost to buy back, that gain goes to APIC. Certain stock dividends, conversions of bonds into stock, or even receiving donated stock can create APIC. It's basically a bucket for various capital contributions that aren't par value or retained earnings. It's often just shown as one aggregated number.
Okay. And then retained earnings, accumulated profits not paid out.
Yeah.
Pretty straightforward.
Mostly, yes. Retained earnings is the sum of all net income and losses over the company's history, less all dividends declared. It represents the earnings reinvested in the business.
So net income minus dividends equals the change in retained earnings.
Generally, yes, but you also have to factor in adjustments like prior period error corrections or the cumulative effect of certain accounting principle changes, as we discussed. These can directly increase or decrease the beginning balance of retained earnings. Also, it does not include AOCI or treasury stock. If the account balance is negative due to accumulated losses, it's called a deficit.
Can companies restrict retained earnings? I think you mentioned appropriations.
Yes, companies can appropriate retained earnings. This doesn't mean setting aside cash. It's purely a bookkeeping entry to signal that a portion of retained earnings is not available for dividends. This might be due to legal requirements, loan covenants, or just the board deciding to earmark funds internally for future expansion or contingencies. The key is it's just a disclosure within equity. It doesn't actually move cash or prevent losses from reducing total retained earnings.
Got it. Now, treasury stock. Companies buying back their own shares. What's the purpose and how does it hit the equity section?
Companies buy back stock for various reasons. Maybe they think it's undervalued, or they need shares for employee stock option plans, or they want to increase earnings per share by reducing the number of shares outstanding. Treasury stock is the company's own stock that it has issued and then reacquired but not formally retired.
And it reduces equity.
Yes. It's shown as a reduction, usually at the bottom of the equity section. Shares held as treasury stock lose their voting rights and don't receive dividends. Also, some states require companies to restrict retained earnings by the cost of treasury stock held, making those earnings unavailable for dividends.
How do they account for it? You mentioned two methods.
Right, the cost method and the legal or par value method. The main difference is how and when gains or losses on treasury stock transactions are recorded within equity.
And these aren't really gains or losses that hit the income statement, right?
Absolutely correct. Crucially, transactions in a company's own stock never result in income statement gains or losses. Any difference between the buyback price and the reissuance price is treated as an adjustment within stockholders' equity, usually affecting APIC and sometimes retained earnings.
Okay. So the cost method is more common. How does it work?
Yes, the cost method is used most often. You simply record the treasury stock at the price you paid to reacquire it, the cost. When you later reissue those shares, if you sell them for more than the cost, the excess gain is credited to an account like additional paid-in capital treasury stock. If you sell them for less than the cost, you first reduce any existing balance in that APIC treasury stock account from previous gains. If that's not enough to cover the loss, then you reduce retained earnings directly.
So gains increase APIC, losses reduce APIC first, then potentially retained earnings. But never income.
You got it. Net income is never increased by Treasury stock transactions.
And the legal or par value method, how's that different?
The legal or per stated value method is more complex and less common. When stock is reacquired, it immediately removes the original par value and a portion of the original APIC associated with those shares from the respective accounts. The treasury stock itself is recorded at par value. Gains or losses on reissuance are handled similarly through APIC treasury stock and potentially retained earnings. It tries to maintain the original sources of capital more distinctly.
But the total equity ends up the same under both methods.
Yes, that's the key takeaway. While the internal breakdown between capital stock, APIC, and treasury stock looks different on the balance sheet, the total stockholders' equity figure will be identical regardless of which method is used.
What if the company decides to formally retire the treasury stock instead of reissuing it?
If they retire it, the accounting depends on whether the retirement price, the original cost under the cost method or par under the par method, is more or less than the original par value. Any difference is usually run through APIC related to that stock class and potentially retained earnings if APIC isn't sufficient.
One last thing on this. What about donated stock? If someone just gives shares back to the company?
Donated stock is interesting. Receiving it doesn't change total stockholders' equity because the company is just getting back its own shares. However, it does reduce the number of shares outstanding, which increases book value per share. The company records the donated stock at its fair market value on the date of receipt, with a corresponding credit to donated capital, which is a form of APIC. When the donated stock is later sold, the cash received is recorded, the treasury stock account is removed, and any difference hits APIC.
Okay, that covers acquiring stock. Now, what about issuing new stock, especially to non-employees? How does that process work?
Issuing new stock is how companies raise equity capital. The accounting is pretty straightforward. You record the cash or other assets received. You credit the capital stock account for the par or stated value of the shares issued.
And if they sell it for more than par?
If it's sold above par, the excess amount goes into additional paid-in capital. If sold at par, it's just cash for capital stock. Selling below par is rare and creates a discount debited to APIC, which might represent a contingent liability for shareholders.
What about stock subscriptions? Selling shares on credit?
With stock subscriptions, the company gets a commitment before receiving cash. They record a subscriptions receivable, an asset, and a credit common stock subscribed, an equity account representing the commitment, and APIC for any excess over par.
So the stock isn't issued yet.
Not until it's fully paid. When cash is collected, you reduce the receivable. Once fully paid, you reverse the common stock subscribed account and issue the actual common stock. If the subscriber defaults, the company might issue partial shares, refund the payment, or keep the cash as forfeited, crediting APIC.
And stock rights for existing shareholders.
Stock rights give existing shareholders the chance to buy more shares, usually at a discount. Just issuing the rights doesn't usually trigger a journal entry, maybe just a memo. When the rights are exercised, the company records the cash received and issues the stock, crediting capital stock par and APIC excess.
What if stock is issued for services, not cash, or in a bundle with other securities?
If stock is issued for services, it's recorded at the fair market value of the stock issued, or the fair value of the services received if more clearly determinable. If stock is sold in a basket with other securities, like bonds, the total proceeds are allocated among the securities based on their relative fair market values.
Okay, so they've issued stock. Now, distributing earnings back to shareholders' dividends. How do companies handle the different types?
Right, dividends are the main way companies return profits to shareholders. It's a pro rata distribution, meaning each share gets the same amount. Cash dividends are the most common.
There are key dates involved, right?
Yes, 3 important dates. Date of declaration, that's when the board of directors formally approves the dividend. At this point, it becomes a legal liability for the company, and retained earnings is debited, reduced. Date of record shareholders who own the stock on this date are entitled to receive the dividend. No journal entry here. Date of payment when the company actually pays the cash. This entry reduces the liability, dividend payable, and reduces cash.
So cash dividends are simple. What other kinds are there?
Companies can also issue property dividends, sometimes called dividends in kind. This means distributing non-cash assets like inventory or investments in other companies.
How is that valued?
The property being distributed must first be restated to its fair market value on the date of declaration. Any gain or loss from this restatement is recognized in the company's income statement. Then, retained earnings is debited for the fair market value of the property being distributed.
Interesting. So that can impact net income. What else?
There are scrip dividends. This is basically an IOU. The company wants to pay a dividend but is short on cash, so it issues a special note payable promising to pay the dividend later, possibly with interest. Retained earnings is still debited on declaration. And then there are liquidating dividends. These aren't distributions of earnings, but a return of capital. This happens if a dividend exceeds the balance in retained earnings. The excess reduces additional paid-in capital and potentially even the capital stock accounts. It signals the company is returning invested capital, not profits.
And stock dividends, giving shares instead of cash. You mentioned small versus large earlier.
Right, stock dividends are distributions of the company's own stock. The accounting differs significantly based on size. A small stock dividend, generally defined as less than 20–25% of the outstanding shares, is assumed not to significantly impact the stock's market price. Therefore, the company debits retained earnings for the fair market value of the shares being issued. Capital stock is credited for par, and APIC gets the excess.
So market value comes out of retained earnings for small ones.
Yes, but for a large stock dividend, more than 20–25%, it's assumed it will materially reduce the market price, similar to a stock split. So for large stock dividends, retained earnings is only debited for the par value of the shares issued. The credit goes only to capital stock par.
Ah, big difference there. Market value versus par value, debit to retained earnings. And total equity doesn't change in either case, right?
Correct. Both small and large stock dividends are just reclassifications within stockholders' equity. Total equity remains unchanged. It's just moving amounts from retained earnings into the capital stock and possibly APIC accounts. Retained earnings are being capitalized.
How does this differ fundamentally from a stock split?
A stock split also increases the number of shares, but it does so by reducing the par value per share proportionately. There's typically no change to retained earnings or APIC or total equity. Often, only a memo entry is made in the accounting records to note the change in par value and the new number of shares outstanding. A 2-for-1 split, for example, doubles the shares and halves the par value. It's more about adjusting the market price per share, often to make it more accessible.
Got it. Split changes par, stock dividend capitalizes retained earnings. How do companies summarize all these equity changes over a period?
That's the job of the Statement of Changes in Shareholders' Equity. It's one of the primary financial statements. Its purpose is to detail all the changes in each component of stockholders' equity during the period.
So it connects the beginning and ending balances.
Exactly. It starts with the beginning balance for each equity account: common stock, APIC, retained earnings, AOCI, treasury stock. Then it shows the activity during the period: net income, which increases retained earnings; dividends, which decrease retained earnings; issuance of stock, repurchase of treasury stock; OCI activity, affecting AOCI; and finally arrives at the ending balance for each component and for total equity. It reconciles everything that happened in equity during the year, like the Sydney Technologies example shows clearly.
Okay, final segment. Even with all these rules and careful accounting, sometimes companies need to change how they account for things, or, let's face it, fix mistakes. How do accountants handle that without making prior year's reports totally useless for comparison?
That's a critical aspect of maintaining credibility and usefulness in financial reporting. Accounting isn't set in stone. Things evolve. JAP provides specific guidance for handling changes in accounting estimate, changes in accounting principle, and error corrections. Each is treated differently, especially regarding whether you go back and change prior periods.
Let's start with changes in estimate. What falls into that category, and how are they reported?
A change in accounting estimate happens when new information or experience leads a company to revise a previous judgment. These are common because the future is inherently uncertain.
Like changing how long you think a machine will last.
Exactly. Changes in the useful lives or salvage values of depreciable assets are classic examples. Others include adjusting warranty liabilities, estimating bad debts, inventory obsolescence write-downs, or settling litigation for a different amount than accrued. Sometimes a change in principle might be inseparable from a change in estimate. Those are treated as estimate changes too.
So how do you report these? Do you restate past financials?
No, that's the key. Changes in estimate are accounted for prospectively,
Prospectively, meaning
meaning you apply the change only in the current period and, if applicable, future periods. You do not go back and restate prior year's financial statements or adjust beginning retained earnings. You just use the new estimate going forward.
like that Carlin Company truck depreciation example.
Precisely. If they initially estimated a 10-year life, but in year 3 revise it to only 5 years total, they don't recalculate year 1 and 2 depreciation. Instead, they take the truck's current book value at the start of year 3 and spread that remaining value over the new remaining useful life, which is now just 3 more years, year 3, 4, 5. It reflects the best information now without altering the past. Disclosure is required if the change is material.
Okay, so estimates are forward-looking.
Hmm.
What about a change in accounting principle? That sounds like a bigger deal.
It generally is. A change in accounting principle occurs when a company switches from one acceptable JAP method to another, like changing inventory costing from LIFO to FIFO,
Yeah.
or changing revenue recognition methods if alternatives are allowed.
Can companies just switch whenever they want?
No, there are restrictions. The change is only permitted if the new principle is required by a new GAAP standard, or if the company can justify that the new principle is preferable, meaning it provides more reliable or relevant information than the old one. You can't just switch to manage earnings.
How are these reported? Prospectively, like estimates.
Generally, no. The general rule for changes in accounting principle is retrospective application.
Retrospective, meaning you do go back.
Yes. You need to calculate the cumulative effect of the change. This is the difference between what beginning retained earnings would have been in the earliest year presented if the new principle had been used all along compared to what was actually reported under the old principle.
Like the Harbor Company example, switching LIFO to FIFO.
Exactly. If switching to FIFO would have resulted in $200,000 higher pre-tax income cumulatively before the start of the earliest year shown, you calculate the after-tax impact of that, $840,000 in their case, using a 30% tax rate. That $140,000 is then recorded as an adjustment to the beginning retained earnings balance of the earliest year presented in the financial statements.
Wow, so you adjust the starting point.
Right. And furthermore, if you present comparative financial statements, like showing this year and last year side by side, you must restate those prior year statements as if the new principle had been used then too. This makes the comparative statements consistent and truly comparable under the new method.
That seems like a lot of work, restating prior years. Are there exceptions where you don't apply it retrospectively?
Yes, there are 2 important exceptions where retrospective application isn't required, and these are key test points. First, if it's impracticable to determine the cumulative effect or restate prior periods. This might happen, for example, if a company switches to the LIFO inventory method, because reconstructing historical inventory layers might be impossible. In such impracticable cases, you apply the change prospectively, like an estimate change.
Okay, impracticability is one. What's the other?
The second one is unique. A change in depreciation method, like switching from straight line to double declining balance. GAAP views this as a change in both principal and estimate. Because of this dual nature, it's accounted for prospectively.
So, like an estimate change. No restatement, no cumulative effect adjustment.
Correct. You just apply the new depreciation method to the asset's current book value starting in the year of the change. No going back. It's a specific exception that often surprises people.
Good to know. What if the actual entity being reported changes? Like if a company starts consolidating subsidiaries it didn't before.
That's called a change in accounting entity. It occurs when the group of companies included in the financial statements changes. The rule here is also retrospective application. You must restate the financial statements of all prior periods presented to reflect the information for the new current entity. This ensures comparability of the entity's scope across all years shown. Full disclosure is also required.
Okay, that leaves one category, straight up errors. Not changes in estimates or principles, just mistakes. How are those fixed?
Error corrections are different from accounting changes. They arise from things like mathematical mistakes, applying GAAP incorrectly, overlooking information that was available, or misusing facts. Importantly, changing from a non-GAAP method to a GAAP method is treated as an error correction, not a change in principle.
So how do you report fixing an error from a prior year?
It's treated as a prior period adjustment. How you report it depends on whether the year the error occurred is being presented in comparative statements. If you are presenting the financial statements for the year the error occurred, you simply correct the error directly in that prior year statement.
Okay, just fix it where it happened if that year is shown.
Right. But if you're presenting comparative statements and the error occurred in a year before the earliest year shown, you adjust the beginning retained earnings of the earliest year presented, net of tax.
Adjust the starting point again, like the cumulative effect.
Exactly. And if you're only presenting the current year's statements, no comparatives, you adjust the opening balance of retained earnings for the current year, net of tax. The goal is always to present the financial statements as if the error had never occurred.
So using that Jordan manufacturing example again, if they found a depreciation error from years 1 and 2, and they changed from LIFO to FIFO in year 4, and they were only showing year 4 financials, how would retained earnings look at the start of year 4?
Okay, great scenario. For Jordan Manufacturing showing only year 4, first, the depreciation error from years 1 and 2. Since those years aren't presented, the correction, say $2.7 million net of tax, would be an adjustment that reduces the beginning retained earnings balance reported for year 4. Second, the change from LIFO to FIFO. This is a change in principle requiring retrospective application. The cumulative effect, say a $3 million increase net of tax for years 1 to 3, would be an adjustment that increases the beginning retained earnings balance for year 4.
So the beginning retained earnings number for year 4 would be adjusted for both the error correction and the cumulative effect of the principal change.
Precisely. Both adjustments would hit that opening balance net of tax, ensuring that the starting point for year 4's equity reconciliation is accurate, reflecting both the corrected past error and the impact of adopting the new accounting principle. It's all about getting that foundation right.
Wow, okay. We have definitely covered a lot of ground today. We've gone from the basic building blocks, the financial statements themselves, all the way through to complex things like earnings per share, the details of stockholders' equity, and even how companies handle changes and fix mistakes.
We really did. And it shows that these concepts, while they can seem dense or technical, are truly fundamental. They're the language businesses use to communicate their health, their performance, their very structure. Understanding the balance sheet snapshot, the income statement story, comprehensive income's full picture, it gives you a much deeper appreciation for what's going on.
Absolutely. It's clear that being well-informed about these nuances, these details of financial reporting, gives you a huge advantage. It takes you way beyond just skimming headlines or looking at that final net income number.
Exactly. It's about seeing the why behind the numbers, understanding the strategic decisions reflected in discontinued operations, the impact of global currency flows, the structure of ownership revealed in the equity section. It all tells a richer story.
So the next time you look at a company's financial report, don't just see numbers scattered on a page. Think about those strategic choices, the currency impacts, the ownership claims that each line item represents.
What hidden stories might you uncover when you dig a little deeper?